Hey everyone, and welcome to today's Explainer. Today we are tackling what is arguably the single most powerful force in the entire US economy, interest rates. We're going to solve a really fascinating macro to micro mystery together. We'll trace exactly how a single decision made in a boardroom in Washington, D.C., ripples outward, transforming consumer habits, completely shaking up corporate profit margins, and ultimately driving the numbers you see in your very own 2026 investment portfolio. It's an incredible chain reaction, and honestly, understanding it is the absolute key to making informed financial decisions. So, let's dive right in. Here is our roadmap for today. First, we'll look at the power of interest rates. 2, how rates impact stock prices. 3, a sector-by-sector market breakdown. 4, navigating expectations and market volatility. And finally, smart investment strategies for 2026. All right, Section 1, the power of interest rates, starting at the source. Okay, let's dive into this. To really get interest rates, you've got to meet the architect behind the scenes, the Federal Reserve. The Fed juggles this massive dual mandate. Basically, they need to promote maximum employment while keeping prices stable by controlling inflation. And their main weapon to balance these two monumental tasks? The benchmark interest rate. If inflation is running too hot, they raise rates to cool down demand. But if the economy weakens, they lower rates to encourage borrowing and hiring. So how does this actually play out in the real world? Well, it's a direct chain reaction. Step 1, the Fed raises rates. Step 2, borrowing costs instantly rise for pretty much everyone. Step 3, because loans are pricier, consumers tighten your belts and spending drops. People delay buying that new car or maybe that house, which leads us directly to Step 4, declining corporate profits. It's a completely mechanical cascade from a Washington boardroom right down to a company's bottom line. Moving on to Section 2, how rates impact stock prices, the corporate reality. Now, there are 3 specific ways these rising rates end up dragging down stock prices. First off, corporate borrowing. Expensive loans literally force companies to delay expansion. They hold off on building new factories or acquiring competitors, so growth simply slows down. Second, consumer spending. When households are suddenly paying higher mortgage and credit card rates, they immediately cut back on discretionary things. Think travel, electronics, dining out. And third, investment alternatives. Safer options like CDs and treasury bonds suddenly offer higher yields, which tempts investors to pull their cash right out of the stock market and park it in those safer havens. But here is a massive misconception. Actually, scratch that. It's more of a timing illusion. The market literally does not wait for the Fed to act. Financial markets are incredibly forward-looking. Investors are constantly reacting to inflation data, employment numbers, and manufacturing activity months in advance. The market reacts to what it expects the Fed to do. So if Wall Street anticipates a rate hike in 3 months, stock prices are going to adjust today. Section 3, sector-by-sector market breakdown, winners and losers. And this brilliantly illustrates something absolutely crucial. Interest rates aren't universally bad or good. It entirely depends on the business model. Just look at technology. High-growth tech relies really heavily on cheap borrowing to fund research and expansion. When rates rise, they get squeezed hard. Contrast that with financials. Banks actually tend to cheer a rate hike because they earn higher margins on the loans they issue. Real estate, however, takes a pretty negative hit because expensive mortgages stall out home sales. Meanwhile, healthcare is famously resilient. Why is that? Well, because demand for medical treatments and prescriptions remains perfectly stable regardless of what the Fed is doing. But we can't forget the nuance here, right? Take utilities and energy. Utilities are usually considered these safe, defensive stocks because people always need electricity and water. But there's a hidden challenge. Utility companies often carry massive amounts of debt just to maintain their infrastructure. So higher rates can secretly squeeze their profit margins. Energy, on the other hand, dances to its own tune. It's driven heavily by global commodity events, supply chain disruptions, and geopolitics, not just U.S. interest rates. All right, Section 4, navigating expectations and market volatility, lessons from the past. We can actually look right back at the early 2020s inflation fight as a sort of playbook for how to handle all this turbulence. In 2021, inflation climbed well above the Fed's targets. By 2022, the Fed had to initiate these extended, pretty aggressive rate hikes. Then 2023 was characterized by a peak in high volatility and expensive borrowing. But look at 2024. Markets began a full recovery. What history shows us over and over is that while initial rate hikes definitely cause sharp volatility, financial markets invariably recover and adjust once inflation is brought under control. That is, assuming a severe recession is avoided. The sky wasn't falling, the economic gears were just shifting. Which brings us to Section 5, Smart Investment Strategies for 2026. The individual level. When volatility hits the market, we generally see two very different investor paths emerge. First, there's the panic seller. They react emotionally to absolutely every headline, attempt to perfectly time Fed decisions, and essentially just sell out of fear. But then you have investors like Robert and Lisa, personas drawn directly from the research. They're engineers who did not panic when rates rose. They kept an emergency cash reserve so they wouldn't be forced to sell. They maintained their broad index funds, and they simply stayed the course. By staying diversified, they fully participated in the subsequent market recovery that the panic seller completely missed out on. So what was Robert and Lisa's secret to staying so cool under pressure? One fixed amount invested on a regular schedule. It's called dollar cost averaging. By committing to invest a set amount every single month, whether the market is up, down, or going sideways, you naturally buy more shares when prices are low and fewer when prices are high. And most importantly, this completely removes the exhausting, practically impossible pressure of trying to time the market. So, what should you ultimately take away from all this? Well, here is a core set of expert recommendations for 2026. Focus heavily on your long-term goals instead of obsessing over daily fluctuations. Diversify your portfolio across different sectors. Remember how we talked about tech and healthcare responding differently? Use that to your advantage. Avoid emotional decisions driven by the short-term news cycle. Always keep an emergency fund so you're never forced to sell stocks at a loss just to cover an unexpected bill. And finally, periodically reevaluate your risk tolerance. Patience and discipline will always outlast temporary interest rate cycles. I want to leave you with this final, somewhat provocative thought to chew on. Next time you see a blazing red alert headline about the Federal Reserve, ask yourself, are you reacting to today's rate announcement or are you investing for tomorrow's recovery? Building compound wealth really isn't about predicting every single move the central bank makes. It's about structuring your finances so that you can weather the storm and capture the growth that inevitably follows. Thanks so much for joining me on this explainer today, and remember, stay focused on the long game.